London's silver market went completely dark this morning. Phones are going straight to voicemail. There are no quotes. Withdrawals are sitting in a queue going absolutely nowhere. And here's the detail that should stop you cold. An industrial buyer, a real one, offered $200 an ounce for immediate physical delivery of silver. $200. And they could not find a single seller. Not one. Let that satisfy your curiosity about whether something unusual is happening, because what I'm about to walk you through over the next several minutes is not speculation. It's what we are watching unfold right now, in real time, on what should be a perfectly normal trading day. Welcome to the Daily Metals Briefing. I'm going to take you through exactly what happened this morning in London, what it means, and why you need to be paying very close attention to the next few hours. Because what's happening in London right now is the equivalent of cardiac arrest in the heart of global physical silver trading. And when the heart stops pumping, it doesn't matter how healthy the rest of the body looks on paper. Everything downstream is in trouble. So let's start with what we observed at 9:15 this morning, London time. Normally, during the fix window, there is chaos. Controlled chaos, but chaos nonetheless. You see spreads tightening. You see volume bursts. You see the scramble of dealers and institutions positioning ahead of the daily fix. That's what a living, functioning market looks like. That is not what we saw this morning. The chart looked unnaturally flat, managed, almost eerily still. If you've watched markets long enough, you know that kind of stillness. It's not peace. It's the stillness before a dam breaks. So we started making calls, and this is where things went from unusual to genuinely alarming. We called the governing body's general line for the London market, straight to voicemail, no human being picked up. We called a major precious metals desk at one of the key banks, voicemail. We called another bullion desk, one that is always active, always staffed. We let it ring over 40 times. 40. Eventually it clicked over to a full mailbox. Not even room to leave a message. Then we tried a vault operations contact, someone who is always reachable because vault operations don't sleep when metal is moving. Voicemail. After the phone calls failed, we followed up through every channel available. Email, WhatsApp, Signal. Nothing came back. No replies, no acknowledgements, no, we'll get back to you. Just silence. And I need you to understand the timing here, because someone is going to try to explain this away. Today is Monday, December 29th. It is the first full trading day after Christmas. This is not a bank holiday. This is not a weekend. The London market is supposed to be open and functioning. Desks are supposed to be staffed. Phones are supposed to be answered. And yet, across every major contact point in the London silver market, there is nobody home. Now let me explain why this matters so much, because if you don't trade silver or work in metals, you might wonder why London specifically is such a big deal. London is the coordination hub for massive wholesale physical silver trading on a global scale. London is where metal gets vaulted to back the paper structures that the rest of the world relies on. It's where silver gets sourced, swapped, leased, and delivered. When institutions need to move large quantities of real metal, London is the infrastructure that makes it happen. So when London goes silent, it's not just a local inconvenience. It means the artery is clogged. It means the screen price you see on your trading platform, that number that ticks up and down all day, becomes theater. It's not real price discovery anymore. It's a number on a screen disconnected from the physical reality underneath it. And that brings us to the question you're probably asking. If this is really happening, if physical silver is genuinely this tight, why isn't the price screaming higher? Why isn't the chart going vertical right now? And this is the part that requires you to think carefully, because the answer is not complicated, but it is uncomfortable. The price isn't moving because the market is not behaving freely. When the stakes get this high, free market behavior gets replaced by something else. What we appear to be looking at is a deliberate stand down. Bids removed on purpose, participants told to stop talking. Everyone stepping back from the phones at the same time, in the same way, on the same morning. That doesn't happen by accident. And the logic behind it, if you think about it from the perspective of those managing the system, actually makes sense. If the market were allowed to function freely right now, here's what would happen. Industrial buyers would see the real tightness and immediately alert their boards. ETF holders would start questioning whether the metal backing their shares actually exists and is accessible. And you'd get a synchronized run from paper into physical metal, a cascade. That's the nightmare scenario for anyone managing this system. So the strategy is straightforward. Delay the run, slow down conversions, keep the phones quiet, make the market look stable and calm on the surface while the US session opens and can be managed in a controlled way. Containment, not panic. That's what this looks like. And then, late this morning, we got a message that confirmed exactly what we suspected. A major vault in London sent communication indicating that silver withdrawals are now queued pending a compliance review due to, and I'm quoting here, market disruption. Now pay very close attention to the language. This was not framed as temporary. This was not described as a brief delay while systems catch up. This is a full lock. If you have allocated silver in a London vault, that's supposed to mean specific bars with specific serial numbers, set aside specifically for you, your metal sitting in a vault with your name on it. But right now, the gatekeeper is refusing to open the gate. You have paperwork, you have a claim, but you do not have accessible metal. Your property rights have been paused, not by a court, not by a legal proceeding, but by a management policy decision. And here is the critical insight. When vaults are locked, the silver that everyone assumes is available isn't. It's there. It's sitting in the vault. The vault might be completely full, but if nobody can take it out, it might as well not exist. You don't discover a shortage by seeing empty vaults. You discover a shortage by seeing full vaults that nobody is allowed to open. Now let's talk about what's happening in the real economy while London is playing dead. Because this is not just a financial market story. This has immediate, tangible consequences for actual businesses and actual people. The real economy runs just in time. Modern supply chains don't stockpile months of inventory. They hold days, sometimes barely that. We received information this morning from a US-based solar supply chain manufacturer. Their supplier has informed them that they cannot fulfill their first quarter order because they are unable to secure European metal. This manufacturer has 11 days of silver inventory on hand, 11 days. After that, the facility shuts down. That means layoffs. That means delays cascading through their customer commitments. That means contract penalties. This is not theoretical. This is happening right now, today, to a real company in a real supply chain. And here's the detail that should make your stomach drop. This manufacturer authorized whatever it takes buying. They told their procurement team to go out and get the metal at any price. Their buyer offered $200 an ounce for immediate physical delivery. That is roughly 6 to 7 times the current screen price. And there were no sellers, none. Think about that for a moment. A real industrial buyer with real money offering a massive premium for real metal. They need to keep their factory running, and they cannot find anyone willing to sell it to them at any price. The true price of physical silver right now is not what you see on the screen. The true price is hidden, because revealing it would expose the shortage and put catastrophic stress on the entire paper structure built on top of it. And it's not just London. Let's look at what's happening in Switzerland, because Swiss refiners are a critical link in the global silver supply chain. They take raw material, concentrates, scrap, and turn it into the high-purity products that industry actually needs. We're getting reports this morning that Swiss refiners are implementing what they're calling temporary export reviews. That sounds benign. It's not. It adds delay. It adds friction. It creates another bottleneck in a system that is already seizing up. Now combine the Swiss friction with the London lock. What you get is a global traffic jam. The raw material might exist somewhere in the world. Concentrates are sitting at mines. Scrap is in recycling facilities. But the pipeline that turns those into deliverable, usable silver is jammed. The metal cannot flow to where it needs to go. And the consequences of that jam are real, and they are spreading. Solar panel production gets delayed. Electronics manufacturers can't source components. Medical device companies face shortfalls. Defense contractors can't get the silver they need for critical applications. And when countries start seeing their domestic industries threatened by a global supply crunch, the response is predictable. Resource nationalism. Countries start prioritizing domestic supply. They restrict exports. They hoard. And once that starts, the global market doesn't just tighten, it fractures. Every country for itself, every buyer front-running every other buyer, and the cooperative international market that everyone relies on starts breaking apart. So let's zoom out and connect these dots, because individually, each of these data points is concerning. Together, they tell a story. London is quiet. Withdrawals are queued, allocated metal is delayed, a $200 bid was rejected because there are simply no sellers. Refining capacity is tight and getting tighter. The market is technically open. You can look at a screen and see a price, but the market is broken. The price is irrelevant if you can't buy size and take delivery at that price. So what should you actually be watching? Forget the charts for a moment. The metrics that matter right now are how many ounces are leaving vaults today, what the turnaround time is at refiners, and how many days of stock manufacturers have left on their clocks. Those are the numbers that tell you what's real. Charts measure agreements between traders. They measure the paper price. They don't measure metal. And in a market like this, liquidity dies long before the headlines catch up. Now let's talk about what to expect when New York opens, because we are a few hours away, and there is a playbook for this. If you've watched these situations before, you know what's coming. Expect turbulence. Specifically, Expect a sudden dump. A sharp red candle designed to trigger stop losses, scare paper holders into selling, and ease conversion demand from people trying to move from paper to physical. It's a pressure release valve. If they can shake out enough weak hands in the paper market, it reduces the number of people showing up at the vault door asking for real metal. And the narrative around it will be carefully constructed. You'll hear about holiday liquidity being thin. You'll hear about technical issues, wide spreads, nothing to worry about. And the most clever one, gold is trading normally. So the overall precious metals market is fine. Watch for that because it's designed to make you look at gold and feel reassured while ignoring the fact that silver is flatlined. And the reason gold can trade normally while silver can't is the whole point. Silver has thinner inventories and massive industrial demand pulling on the same supply that investors want. Gold doesn't have that problem to nearly the same degree. So gold being normal and silver being abnormal isn't a sign that everything is fine. It's a signal that silver specifically is in crisis. So what does a real squeeze actually look like? Because most people think it looks like a chart going vertical, a massive green candle, price ripping higher. That's not how it starts. A real squeeze starts quietly. It starts with out-of-stock notices on dealer websites. It starts with premiums exploding even while the spot price stays flat, because the spot price is a paper price and the physical market is somewhere else entirely. It starts with delivery times stretching from days to weeks to, we'll let you know. The spread between the paper price and what you actually have to pay for physical metal in your hand becomes the true price signal. And then watch for the excuses. Delays blamed on logistics. Allocation limits, where a dealer tells you they can only sell you a certain quantity. Substitution, where you order one product and get offered something else. Smaller bars, different formats, whatever they have left. Those are rationing signals. That's what the early stages of a supply crisis look like in real time. And I want to leave you with a couple of questions to think about, because this is not just an abstract market story. What happens when multiple industries are bidding for the same shrinking supply simultaneously? Solar, electronics, medical defense, all competing for metal that isn't there? And here's the other one. If you hold paper silver, an ETF, a futures contract, an unallocated account, what do you actually own right now? Today? If the vault won't open, if delivery can't be made, if the phone goes to voicemail when you call, what is that piece of paper actually worth? Drop your answers in the comments. I genuinely want to hear what you're thinking, because this community has been ahead of these developments consistently. And make sure you're subscribed, because we will be doing a follow-up the moment the New York session opens, and we can see what's actually happening on the ground. Here's the pattern to recognize, and it's important. The system does not announce a crisis. It gatekeeps, it rations, it contains. The language stays calm. The surface stays smooth. And by the time the public gets around to naming what's happening, the insiders have already positioned. That's how these events work, every single time. Industry doesn't bid aggressively and publicly when it's desperate. It bids aggressively and privately, because there are no substitutes for silver in most industrial applications and there is no time to wait. The quiet is the signal. The calm market is the danger. The best inventory is gone before the noise hits. Here's what to watch in the next few hours and days. New York physical premiums versus the paper price. Out-of-stock banners showing up on major dealer websites. Delivery time estimates expanding. And above all, whether the London silence persists. Because if this were a glitch, a technical hiccup, a holiday staffing issue, it would clear. Glitches resolve. Systems come back online. Phones get answered. If this stand down persists through tomorrow and the day after, that tells you it's not a glitch. That tells you it's policy. And I want to end on something that might be uncomfortable, but you need to hear it. If you hold unallocated silver, meaning your metal is pooled with everyone else's in an account where the custodian owes you silver but hasn't set specific bars aside for you, then in a stressed system, you are a creditor. You are standing in line with every other creditor, hoping the institution can make good on its obligations. That is a fundamentally different position than holding physical metal in your own custody. Because when you hold physical metal, you don't need anyone's permission. You don't need a vault operator to approve your withdrawal. You don't need a compliance review to clear. You don't need someone to answer the phone. What London showed us this morning is what gate control looks like when demand gets serious. They don't tell you there's a problem. They just close the gates. Make sure you're subscribed. Turn on notifications. We are going to be covering this in real time as it develops. And here's my question for you. We are roughly 4 hours away from the New York Open, walking into what might be a metal-less market. What's your first move? Tell me in the comments. And stay tuned, because this is far from over.